I would now like to welcome my long-standing friend, David Kaufman. David is the founder and CEO of Westcourt Capital, and David is truly a Canadian leader within the alternative investment industry. David literally facilitated the first 3 years of our conference, and he was the best facilitator. It was, in the days when I wasn't doing it, and he came and helped and supported, and it's such a delight to have him back here as the keynote. So I just want to welcome him now. David, you're there. Looking forward to your talk, and enjoy. Thanks.
Good morning. And thank you for having me. I'd like to start by thanking everyone for being here today. And Karen, I have to give you great credit. You're doing an extraordinary job under really extraordinary circumstances. It's interesting thinking back to January when you asked me to speak today, and I came up with the idea about speaking about asset allocation and portfolio construction. And then of course, when COVID hit and everything was up in the air, I thought, I guess I'm gonna have to, create a new speech because clearly it's gonna have to be about COVID. And then I realized when I thought about it more, that the idea about how to construct portfolios is always important, but even more so right now during COVID. So actually, I ended up putting together exactly the same notes that I would have even in the absence of COVID. And so I want to congratulate you and the team for putting this together. And I'd like to begin today. I'm going to be sharing my screen in a minute by mentioning that over the last 11 years at Westcourt, we've allocated well over $4 billion for a variety of types of investors, including ultra high net worth, foundations and trusts, and pension funds as well. And one of the things that we've noticed over that time is that as these participants create portfolios, that they seem to depart from sort of the orthodoxy of how portfolios ought to be constructed. And that's what I want to talk about today. So with your permission, I will share my screen, and I hope this works, and please forgive me in advance for any technical issues, but I think that we are okay. And I believe hopefully my screen is now being shared and this is working properly. So the title of my talk today is Pulling Back the Curtain, How Smart Money Builds Portfolios. And I want to dive right into this by talking about, and there we go, by talking about what I'm calling the academically accepted asset allocation approach, the quintuple A. This is sort of how, things are done. And I'm using air quotes for those of you who can't see me right now. And so the basic approach for how portfolios are created is that you have to begin by determining your risk and return objective. And what this means in this context is that you have to be able to determine your risk and return objectives in percentages. You have to be able to say, I want to make a 6% return. I don't want my standard deviation to be more than 6. I want a Sharpe ratio of 1. And that's something that you're supposed to be able to identify quickly in a numerical way. And then once you've done that, you have to be able to identify the investable asset classes to create a universe from which to choose to build a portfolio. And that, of course, is significantly limited by asset classes and managers that have long-term data so that the data can be used to create the optimal portfolio. So in the absence of those data, it's very difficult to do step 2. But once you've done step 2, this is where you have to develop forward-looking capital markets assumptions. And the reason that I have backward here in parentheses is that the idea about developing forward-looking capital markets assumptions is entirely dependent on being able to look at how things have done in the past, because without understanding how those data have come to be, it's very difficult to create any assumptions about what's going forward. And then once you've done to this, then it's time to put the meat into the machine and create the sausages, and you optimize your portfolio. And this is entirely math-based. And it's funny because when I showed one of my associates this line, they said, oh, if you're going to insert the chart, you should insert the chart. But no, the reason it says insert pretty pie chart here is that if you're going down the academically accepted asset allocation approach, if you're going down this road, you necessarily have to end up with a pie chart, because that's going to govern how you work in the future. And then once you have that pie chart, then you can get down to the business of selecting your investment managers. And let's talk a little bit more about step 4, which is optimization. And here you have a picture of Harry Markowitz, who truly was a pioneer of modern portfolio theory, which is now 60 years old. He did win the Nobel Prize for his work. And essentially what came out of it was the notion of the efficient frontier. And I'm not going to go into it in detail because all of you are no doubt familiar with it. But in one sentence, it creates an optimal portfolio whereby if you're seeking a defined rate of return, you can determine which mix in your portfolio will require the least risk to achieve that return. Or if you have a defined amount of risk you're willing to take, it will tell you which constituents of the available managers or strategies will give you the highest rate of return for a defined level of risk. Things to note about this. First, very small changes in your estimates that you use in the sausage machine will give you vastly different optimal portfolios. So that if you think on a forward-looking basis that equities will return 7 and it turns out to be 6, that is a significantly different result than you might expect once you run things through the sausage machine, as I say. It also assumes a lot of things. And these are big assumptions. A normal distribution, in other words, things like March 2020 don't exist. It means that the ride is essentially exactly as expected, where positive and negative returns are distributed around the mean in a very smooth way. It also assumes that you have efficient markets, which is, of course, not true anywhere, but especially not true in places like Canada, where we have such a small market compared to on a global basis. And of course, no taxes. Wouldn't that be nice? But so that if you can assume that you have normal distribution, efficient markets, and no taxes, the concept of optimization might be more useful. But as I said, that doesn't really work. So then we go on to the notion of cherry-picked constraints. So when you do mean variance optimization, you have to put in constraints. And those constraints might be, for example, that the investment policy statement of a foundation says no less than 40% of the money must be invested in Canadian investment grade fixed income, for example. Or you cannot have more than 60% of your money allocated to Canadian equities. So you have constraints. And what ends up happening is that the constraints actually define the answer. Because, you know, I'm reminded of one of my favorite moments in television history where Kramer decides on Seinfeld that he's going to do movie phone, and he's guessing at what the answer is that the people want when they call in. And in the end, he says, why don't you just tell me what movie you want to see? And that's kind of what constraints are all about, that if you keep adding constraints and adding constraints, all you're actually getting when the optimizer spits out the answer is the answer that your own constraints have demanded, because the constraints get quite tight. And so that what all of that, especially once you've cherry picked the constraints, inevitably leads to, and I say, wait for it, here it comes, is a pie chart that typically puts 60% into one asset class and 40% in another. And I've often joked around that, especially in Canada, people treat this concept as though Moses came down from Mount Sinai with 2 tablets. And instead of containing the 10 commandments, one of the tablets said 60 and the other one said 40. And that necessarily means that you get this answer of 60% in equities and 40% in fixed income. And lest you think that this is old fashioned, if you were to go down to King and Bay and look at all of the money that's invested through thousands of advisors across the country, you would see that 60-40 portfolios, or a very small variation therefrom, is what you would see in normal investor portfolios. But they would defend it by saying that's what the optimizer told us. And what I'm here to tell you is that that's not how the smart money actually builds portfolios. And what we can start by doing is taking a look at what do those portfolios look like. So here we have Canada Pension Plan, $400 billion. We have Yale, which is well known for being a pioneer of doing things differently. And then we have ultra high net worth investors across North America. This one's put together by Tiger 21 through significantly large surveys with material data sets to be able to understand how the money's actually allocated. So without spending too much time on this, when you look at these, you think either they have significantly different constraints and a better optimizer, and they're able to predict the future, or maybe they're actually not using the quintuple A model at all. And so I'd like to tell you that it's the latter, not. and talk about now like how to think like smart money. And there's kind of 4 steps here. The first is understand your risk and return goals, but actually, I'll get into this in the next couple of slides to understand that it's not just a question of picking percentages. The second is to understand what game you're playing and what the rules are, and then to find the best available talent for the next game. Because remember, when you build a portfolio, it's not for yesterday's results, it's for the future's results. And that's something that is incredibly important. Then you have to make your final cuts and you have to field your team. And then, and number 4 is a big part, is that the concept that good enough is not good enough, is that while the games are being played, you need to strive to improve through tactical maneuvering. The old concept of, a shark that stops swimming dies. You have to move forward or else you're moving backward. And I want to break these down now for you. And, first, as I say, a word about risk and return, is that one of the things that March 2020 gave us was a very recent example of how people actually react during a crisis. I've always said that the time to talk about your appetite for risk and your ability to withstand risk is not when you're sipping a cappuccino on a beautiful day in your advisor's office and they say, how can you handle risk? And you say, I have cold blood running through my veins. I can handle risk. I understand that markets are choppy. The time really to ask is on March 23rd, 2020, how do you feel about risk now? And how do you feel about setting your return goals now? Because that's when people say, I want to get off the ride. I feel nauseous and I would more than happily take a lower return if I could just reduce the risk that I'm currently enduring. So let's understand that in terms of understanding risk and return goals. But actually, let's turn to the risk side first. And I always start with risk because since we all know that there is no such thing as return without risk, there certainly is such a thing as risk without return. So you have to address risk first. The first question is, how is it defined? And it seems that everyone has a different definition of risk, and most of them are self-serving depending on who's delivering the news. So one way to measure risk, of course, which is commonly accepted, is standard deviation. And that's for where you have daily price discovery of a security, you can measure what the volatility is, which may or may not be a good indication of what the risk is. Long equity managers always define risk as permanent loss of capital. You buy a stock at 100, it goes down to 50. The company is still amazing. You have not permanently lost any capital, but it certainly doesn't feel like you haven't lost any capital when you get your next statement. Then you get to the concept of how much will we accept? And that goes back to the cartoon, which is that we believe that we can accept a lot, but how much will you actually accept? And if you're good at understanding what your actual risk profile is and your appetite for risk, you'll be much better at creating portfolios. The next concept, dollars or percentages, is enormously important because it's one thing to look at someone and say, the data show that a very bad month, you're going to lose 3%. 3%, that's only 3%, doesn't sound like a lot. And then you remind them that on a $100 million portfolio, they're going to get a statement at the end of that month saying that they lost $3 million. And especially for people such as entrepreneurs who have sold a business, they translate that $3 million and say, that was the first 10 years of 30 years that I worked to build my business that I've lost in a matter of days, 8 days in March, and I've lost the first 10 years of work. So when you express it in dollars, because whether you're managing a portfolio for yourself or you're doing it for stakeholders as a representative, in the end, there'll be humans looking at those statements and seeing the losses. And believe me, the dollars have a lot to do with how people react. And finally, what could change our plans? Is that over time, there are, as I often say, you get up to the line of scrimmage and you see a defense that you don't understand. You want to be able to call a timeout because you need to react to what you're seeing in front of you. And COVID's a good example that people have changed their plans over time. And you need to be able to measure sort of manage the risk that you're going to take, understanding that things change. Now let's move over to the return side of things. So the first three, how much, why, and when, are sort of intertwined. How much return do you need, which is different than saying how much return do you want, because how much return do you want, you're going to say as much as I can get without taking too much risk, which is not very helpful when you're building a portfolio. So if you can start to say, well, I would like to keep up with the rate of inflation and I have goals. If I'm a philanthropist, I'd like to donate a fixed amount of money. If I run a foundation, I'm statutorily required to pay out a certain amount of money. And I need to report to my stakeholders on a quarterly basis. And so I need to have those returns relatively smooth so that I can achieve them over and over again on a quarterly basis. And that's the why. And the when, of course, is it's one thing if you're able to say, oh, I have a 50-year investment horizon because the money that I'm managing is intergenerational, or in the case of a pension fund, forever money. That's easy to say, but of course, once again, you need to be able to provide those returns on some periodicity that it can be measurable. And you can't just say, I'll speak to you in 30 years, if only. And does cadence matter, which kind of speaks into the same thing, which is that over time, if you're, up 20, down 10, up 20, down 10, that's a very different ride than up 8, up 8, up 8, up 8. And even though in the end that you might end up in a very similar place, how you get there and the cadence may matter to you a lot more than it might to the next investor. And finally, does composition matter? Notwithstanding the fact that we always purport that money is fungible, which of course it is, which means that as long as your total return exceeds your required cash for a year, that you shouldn't care where it is achieved. Many people focus on identifiable, predictable cash flows along the way, so that if cash flows matter, the portfolio that you build will be necessarily different from a return perspective than if the cash flows or the derivation of those cash flows didn't matter so much. Now let's move on to 2A, figure out what game you're playing. It really matters, the concept that there's a season for everything, whether you're on offense or you're on defense. And what you want to make sure is that you understand heading into it, what period you're in. And so that you're not going to take the World Series champs and say that they're going to go win the Super Bowl. And if the game changes over time, you need to understand that the team that you're going to field is going to have to change along with it. The next concept, that past is not prologue, is obviously true. But building a portfolio definitely necessitates that you have a view on the future, but it also requires that you might ignore the past altogether. A good example of that is that, the 30-year returns on fixed income are very high because we were in a secular trend of lowering interest rates over a 30-year period, which I believe, I've been saying this for 5 years, so eventually I'll be right. I believe we're sort of at the nadir now at zero, which means that those returns might be completely useless to you, and that predicting the future might mean that you have to not even invite to spring training a player who performed really well over a long period of time. This final part is super important, which is you have to understand the rules and whether the goalposts move in the middle of the game. And so here you have to understand that if you're a foundation and you want to make a first down, you need to move the ball forward by 10 yards. If you are a holdco or an individual, you need to move the ball forward 21 yards to make a 10-yard first down, because CRA is going to take 11 of those yards away from you along the way. The other thing you need to recognize is that the rules of the game can change while you're playing the game. And a lot of that has to do with tax. And it's also other statutorily mandated rules that happen along the way. And so you have to understand what's happening as you move along. And then you have to find the best available talent, using the past and the future as your guide. And, as Yogi Berra said, the future is hard. Predictions are hard to make, especially when you're talking about the future. And so that you have to rely heavily on the past. And so here we have 5 different strategies on the last 5 years. And of course, at 60 miles an hour, you look at it and you say, I'd like to have the top 3, both because they ended up in a higher place, but also because, as you can see pictorially, they exhibited significantly less volatility to get to the end point. And then as you look at them, the top 3 here are, and this should be a surprise to nobody, Canadian multifamily apartments, who are on a long winning streak, would be certainly invited to training camp to try and make the team for the future. SPAC arbitrage, which some of you may be familiar with, which is a relatively complex equity-based trading strategy, which has worked brilliantly well over 5 years. And at Westcourt, we've been allocating for 5 years and have well over, I guess, $400 million in that strategy. And Canadian farmland, the smoothest of smooth lines. As long as the world, the population grows and the number of arable acres diminishes, farmland will always be a thing. And then you get to the bottom 2 lines, which again, you probably will have already identified, are Canadian equities and Canadian fixed income. And looking back, you might say, well, at least they're positive over that period, which means that maybe they should be considered for a portfolio. But you can see that when you're looking at the past, thinking, okay, my answer is going to be a 60-40 portfolio of red and yellow, it makes you kind of scratch your head and wonder, well, how can that be? And so that as you go through the process, you identify the universe from which you're choosing, the answer, or at least the answer for day one. You have to consider strategies, asset classes, managers that have done very well in the past that you can handicap on your own, thinking about the future, that they should continue to do well into the future, and not just apply to the modern orthodoxy to say, okay, I'm going to end up with my 60-40 portfolio. So step 3, make your final cuts and field your team. So here we have the 1993 World Series winning Toronto Blue Jays. And if you think about it, at the start of the year, you invite a bunch of players to spring training. And let's say you invite 70 players to spring training, and you're going to have a roster of, say, 25 players on day one, of whom 9 or 10 will be in the starting lineup. If you have a designated hitter, I guess you have 10. And the idea is that during spring training, you're combining Moneyball, which is a well-known concept of using data to determine how you build a team, which is entirely quantitative analysis, with Eyeball, which is qualitative insights to build your team. And as I say here, math is used primarily for negative selection. In other words, you don't get invited to training camp if you have never played well in the past. But because you've played well in the past does not require that you make the team this year. And it's very, very important in that way that you don't allow the math to tell you what to do, but what you can do is that you can use the math to help make negative selections along the way. It can be very, very useful in that way. The other thing is the idea of picking the players versus picking the team, is that you have to focus on the manager and the strategy on its own, and say that it needs to be on my team because it has performed well and I believe it will continue to perform well. It's not injury prone. They're not past their prime. They've performed well in the past. But then you have to ask about things like clubhouse chemistry. These are things you hear all the time, is that you want to make sure that you have a team, a chemistry on the team, a composition of the team, that when they act as a team can form a winning combination in the future when you play your next game. And then the reason that the past matters especially is that, as I say here, who would you trust with the game on the line and an 0-2 count? It's one thing to try and guess how a young player with very little experience, who appears to be at his prime, would perform when the game came down to it and under a very stressful situation. It's quite another thing to say, well, this other player who has been in this situation many times in the past has performed exceptionally well, especially when you compare to the peers. And that person should be on the team, because predicting the future is significantly difficult. And it's important to ensure that as you put the team together, that you keep that in mind. It also applies to strategies, not just managers, which is that I can sit here and say, I'm going to look into the next 5 years and I'm going to think about Canadian apartments. It's true that significantly increasing interest rates would hurt me if I were in that strategy, but I don't believe that's going to happen. I feel very strongly that that won't happen. And as long as they collect their rent, that strategy will work. I've just predicted the future. I can also predict, as I did earlier, that fixed income, Canadian investment grade fixed income will give you a return roughly approximating the coupon, because you won't get capital growth as a result of decreasing interest rates. And let's not forget that out of the coupon that you collect, if you're unlucky enough to be a taxpayer, which most of us are, over 50% of that coupon will go to the CRA, which means that on a real basis, net of inflation, you've sort of lost money. And so that as you look at that, you can say that especially during COVID, these strategies did very well. And what have I learned from that about whether COVID part 2 comes, or we see cyber terrorism, or all of the unknowns? Because one of the things about crises is that you can always depend on them coming, but you can also depend that the source of those crises may be something that you have never thought of before. And finally, don't accept that good enough is good enough is an important concept, because here I have the 1993 Blue Jays opening day lineup on the left. So remember, the Blue Jays won the World Series in 1992. Let's not forget that. And still, they had a number of changes in their opening day lineup in 1993. And as you can see, Darren Jackson, Domingo Martinez, and Dick Schofield, names were crossed out because they were there on opening day. I guess that they had very good spring trainings, and that Cito Gaston thought that they were ready to perform. But then if you look at the right side, you see a very different lineup for Game 6 of the 1993 World Series, where Joe Carter hit his famous home run to win. I was there. It was one of the greatest moments of my life. It was truly exciting. But if you take a look, you can see that a number of the players were moved down in the batting order, mostly to make way for players that performed really well during the year, two of whom, Ricky Henderson, Hall of Famer, and Tony Fernandez, also Hall of Famer, weren't even on the team on day one. That they strove to get better and better during the year because good enough wasn't good enough. And so what you ended up seeing here is that you had to make room for a new player who you felt would be additive, accretive to your results. In the same way that in a portfolio, you should always be rethinking about, I took my best guess at what the best portfolio might be, but now that the game is actually being played and the season is underway, do I still have the strategies and the managers in there, or should I make that are the best, or should I make room for someone I've identified who I think might be even better? And so you see some of the players moving down in the batting order. You see Ricky Henderson, the greatest leadoff hitter in history, right there at number one, and you see a very different result. And so getting better all the time and not being dogmatic about your portfolio and not having what we would call long-term contracts where no matter what happens, that player is going to have to be on the team forever. Note that a number of the players that were there in 1992 weren't even there in 1993. And so that it's the idea about changing it as you go along. And as I said, not being dogmatic, saying, I figured all this out, the numbers proved I was right, I'm going to stick with it, because frankly, that's not a recipe for long-term success. And I thought I would finish this before opening for questions by reliving that wonderful moment where a team achieved its objectives 2 years in a row with very different teams using a different method and model, and still were able to come out on top at the end. And I wanted to make sure that I left room for questions. And so I'm going to stop sharing my screen now. And I hope that I am back on. There, Karen, I see you now. And so I hope that I've left enough time for questions for you.
Oh, we have lots of time. And please, I encourage anyone to send in questions now. We've got, I think we're up to 220 people that have been on, David. What a great presentation. And the way you formulated it to give us a really neat way of thinking about it with the baseball team analogy, that was really cool. So there is one question here from Evan Thompson. David, in your June 16th interview with Karen, you noted that investors can become irrational when faced with uncertainty. Could you speak again about the sum cost fallacy in which investors will see the future as a reflection of the immediate past, and how this irrational bias can hamper them?
Sure. So thank you for that question, Evan. And really, you're talking there about both sunk cost fallacy and recency bias all smashing together to make things even worse. So what we saw during the crisis, fear in March took over, was taken over by greed by the time we hit April and May. But humans are irrational. We already know that, but they're especially irrational during times of crisis. And one of the things that we saw is that people became anchored on what they had invested. I put $1 million in that investment and now it's worth $770,000. I cannot sell it now at a loss. I have to let it get back to even. And of course the question would be, is this the best security or the best investment to get me back to even in the next 12 months? Or should I take the 770 that's left and put it somewhere else where I can have better returns and have a better, remember, the objective is to get back to $1 million. The objective is not to stick with what you had just because you're going to have to realize an actual loss. And the problem with recency bias is that all humans tend to believe that what has happened very recently will happen more often than it would historically. And that's just human nature. And so that it may be that the very strategy that lost you money is the best strategy moving forward to get you back to where you need to be. And a good example of that is credit hedge funds. You know, everybody on this call is aware, no doubt, that March was not a great year for credit hedge. But then when you broke it down, you could see that sticking with it was a good idea, not because you had to get back to even, but because where they stood at that moment was identifiably and predictably going to perform well in the next 6 months. And so here we are 6 months later, and I'm happy to report that in fact that happened, that those predictions came true. But it wasn't because they're on the team, we're sticking with it. It's because we're thinking about the future, and notwithstanding the fact that it caused me pain, do I have the portfolio to get me where I want to be? And so thinking rationally is the hardest thing to do during, you know, when there's massive turbulence in the plane. The pilot, we all hope, is thinking utterly rationally.
Right. How have you managed being in the role that you're in and Rob's in, dealing directly with your ultra high net worth clients? You know, talk a little bit about how you've managed their distress through COVID.
Yes.
And continue to do that.
Right. And so it's too easy to say you're being irrational. That is not helpful. It's like saying to someone, just relax. That's not a helpful way. If, however, you can mix recognizing the irrationality, identifying it, talking about it, accepting it, and helping the client understand that they are in fact being irrational, and helping them discover for themselves that being more rational at that moment, a little more scientific, not utterly visceral. We always have the intellectual and the visceral. You can't be entirely intellectual during a crisis, but you can't be entirely visceral because you'll make some significant mistakes. So Rob and I, we had hundreds of calls for thousands of hours during that period. We also were able, the managers that we worked with were very kind in giving us a lot of their time during the crisis. We recorded 26 podcast interviews directly with the managers, because it's one thing to hear it from me, but it's another thing to hear it from a manager, that people started to figure out for themselves that as bad as things were, and they were bad, let's all remember that March was an incredibly painful period, not just in losses, but in terms of the stress that we were required to endure to get to the next level. And have them discover for themselves how they ought to be thinking about it without just dictating prescriptively, you must think about it differently, because you can't just instruct someone not to be stressed. It's to use the stress to understand how to perform. And now that we're out of it, but let's be clear, we don't know if we're actually out of it yet. You know, in the case of equities, for example, we have this concept of the redo. We say, remember how you acted in March? Well, equities somehow magically are all the way back to where they were in February. And if you didn't like the way you felt in March, you have the ultimate redo right now to rethink about your portfolio to get it ready for the next crisis, so that you don't have to experience quite the same amount of stress. And that's the idea about getting better all the time. And the good enough is not good enough, even though you're all the way back.
Right. And what would you say that your biggest stretch has been, being in the role that you have, very fiduciary in nature, as well as the stretching that your clients have had to, that you've seen and witnessed them changing and stretching into some new paradigms in terms of how they think?
Yeah, thank you. That's a great question that we have always had to think, why and why not? Why are we doing this and why are we not doing something else? And as long as you approach the problem being open-minded enough and not having what we call not invented here syndrome, which is that someone could bring an idea, and if you just think, well, that wasn't my idea, so how good could it possibly be? We hopefully continue to stretch to think about how others have done it. How did they get through a crisis, or how did they get through any kind of turbulent period, which was not really predictable or predicted? And then encouraging clients to stretch a little. Now, interestingly, if someone sells an asset or they win the lottery or money comes out of the sky, they're not fixed to this is how things are done. However, if people have been investors for 20 or 30 or 50 years, in the capital markets. They have very much a this is how things are done approach. So when you talk about stretching, you have to, over time, because this cannot be done overnight, help them understand that how things are done may have worked in the past, may not have worked in the past, but even if they did, will they work in the future? And having people be open-minded to doing things differently. And when you show those pie charts of CPP and the ultra high net worth investor group and Yale and say they achieved their objectives, and those pie charts look nothing like, you know, your mean variance optimization charts, they start to think about doing things differently, but literally changing the paradigm in which that conversation takes place.
Right. Great answer, David. Thank you. Josie Peltier, what is the allocation you recommend to replace 60-40 at this point in time?
Yeah, so can we do another 40 minutes? That's a great question. But what I will say is that to the extent that you're willing to, I hate to use a cliche, but think outside the box. The first would be just start with everything at zero and think about whether fixed income or equities even makes the team in the first place, right? That would be the first thing. And so that we're allocating heavily to real assets because we believe that real assets are evergreen. They always tend to throw off tax efficient income if they're income producing real assets, but also they tend to do very well in inflationary periods because, you know, one of the key components to CPI are things like rent and food. So if you think about farmland and apartments, you want to be the thing that's going up in value at a time where inflation may come along. And if the governments keep spending and printing money, eventually, I suppose inflation is going to have to come unless you're a full, you know, modern monetary theory advocate. And even those people have to admit that inflation would come. So real assets would be one. And the other thing would be truly uncorrelated liquid like SPAC arbitrage, where it's a kind of a unique strategy that trades in equities and is totally liquid, but has very, very low correlations to the markets. And it's one of the few strategies where the strategy effectively can't lose money over time. You're also giving up the 25% returns in most cases, but that's the deal that you want to talk about. Is that it's so things like SPAC arbitrage and real assets, private equity is always there because it's never going to not be a thing. Private debt is a scary concept, especially now when you have distressed borrowers, but it's being opportunistic, but it's also thinking about evergreen. And that's how I would answer Josie's comment or question, is to say, consider allocating to strategies that have always done well, but could do very well in an inflationary environment and a very low interest rate environment.
Great, thanks. I hope that's helpful, Josie. Brennan Carson is asking, how do you balance your manager selection? Canadian firms versus non-Canadian firms. Would you prefer to work with a Canadian manager who invests globally versus a manager with the same investment, not globally?
So, okay, so that question is asked exactly correctly, which is that our bias, we don't have a Canadian bias in terms of it's everything, you know, Canadian equities and Canadian fixed income is the place to be, but we do have a bias on local managers who trade globally. And the reason for that is so long as, remember what we said, you must be this high to ride the ride, okay? Yeah. So long as they truly are among the best in class, they're in the top quartile or top decile in their space globally. If they are local, and I can literally walk down the street and go visit with them face to face and say, what does your book look like today? What are you worried about today? Are you exhibiting style drift? We would much prefer to find a local manager for a global exposure, even if we want the global exposure. And I can tell you this, that Westcourt Capital is a pretty big allocator. And in Canada, we're a very big allocator, which means that we can get the attention of the people whose fingers are actually on the Bloomberg terminal. Whereas if we allocate to a strategy run out of New York, we are not such a big allocator, which means that we will get a biz dev person that every once in a while will grace us with their presence, but they're not the person with their finger on the Bloomberg terminal. And so the kind of information that you're able to gather is not as great. So I would say if you can find a Canadian manager who is top decile globally, who happens to be in Canada, that should be a massive plus and not at all a minus.
Okay. I'm sorry I missed the third strategy you mentioned in your top three with multifamily and farmland.
Well, I think it was SPAC arbitrage, because I wanted to make sure that I was listing a strategy that's liquid. Because, yes, many funds purport to have monthly liquidity, but we all know that you can only, in reality, be as liquid as your least liquid underlying. And so it's hard to sell a bunch of apartments tomorrow morning. But SPAC arbitrage is a 100% liquid strategy, as an example, and so too is credit hedge, where if you believe that you can achieve the returns that you want, but it's entirely liquid, we are not anti-liquidity. We would always want the more liquid version of the same return profile, but in many cases it requires that you go into a less liquid strategy. Farmland's a good example. Anyone that would purport to offer you daily or monthly liquidity in farmland is, selling snake oil, because that's just not possible. And so that's why it's extremely important that you have liquidity, because as I said during the presentation, things change and you have to be able to change with it. And if everything's liquid, you're kind of stuck, right? And so that's why we would always want to have, you better be able to identify a liquidity premium. If you're going illiquid, you better be able to believe that you're getting either access to a strategy that doesn't exist in liquid form, or you're getting significantly higher returns than the one that exists in liquid form could give you. A REIT would be a good example. There's 1 million publicly traded REITs. The problem with publicly traded REITs is that they trade like equities. And so that if the equity markets are down 25%, the REITs might trade down 25%, even though obviously, the apartments that they own or the industrial complexes that they own, the office towers, may not have gone down by the same amount of value during that period.
How can retail investors, non-accredited ones, best access alternatives?
Well,
Richard Remillard, who's
so that's obviously, I'm going to make an entirely self-serving comment, but it is very difficult to access alternatives just by Googling alternative investments Toronto. Because what you're going to end up seeing is that you're going to end up having them come to you, and whoever pays the most to Google will get at the top of the list. What you need to have is a significant due diligence team behind you. Whether you can internalize it, if you happen to be a multi-billion-dollar family, you can internalize that work. I mean, at CPP, they have 1,700 employees. They can do their own work. But that's why a firm that does due diligence, that has a team that focuses on that and only that, would be where you'd want to start. Because telling truth from fiction, especially, Karen, in the illiquid market, is especially important because it's illiquid. In the liquid market, you can say, this is trash, sell. You can't do that in the less liquid markets. And so that having people that understand how to underwrite risk and adjudicate risk, and understand when they speak to those people on the Bloomberg terminals, what they're saying to them, and not just being sold a bill of goods, is something that would be enormously valuable. And so, as I said, that's an entirely self-serving comment, but it's true nevertheless.
When I think about your business and, you're always meeting new ultra-high net worth clients, and these are typically clients that own successful businesses that they've sold or they're going to be selling, and they need someone to help them. Have you noticed through COVID, might be a silly question, but that there's more businesses that are looking for exits or talking to you because this really has just been a layer that they're now going, I want to get this business sold while I can in case things get worse, or something like that?
No, actually, that's an interesting question, because, again, that's not a quantitative thing. So,
oh dear. Well, looks like we might have lost David. Hopefully he can come back.
okay, am I back?
You're back.
Okay, I apologize.
A little blip.
What I just said was so amazing.
Oh, do it again.
Yeah, what I was saying was, and I'm sorry for the internet issue, is that the one time that market timing makes perfect sense, you're only going to sell your business once. So you kind of want to get it right. And so one of the things that you would expect is that people would, I mean, of course, it would be great if you sold your business on March 1st, 2020, because you had cash that was not deployed into the markets, but you had the cash, right? Because you'd sold the business for some high multiple. Is that what we've said to people is that unless you feel that COVID has significantly changed the way you want to live or has changed the way that your business might perform in the future, waiting is clearly a good option, because the world will return to normal, recency bias notwithstanding, and you will have an opportunity. If you truly have a great business, you will be able to sell it at a fair price in the future. But one of the things that people really latch onto then is the fact that a great business that throws off cash flow might have even thrown off great cash flow during COVID. And when they look at, hey, the day after I sell my business, I'm going to have to invest all that capital and it won't be under my direct control any longer. It gives you an even heightened sense of allocating to strategies that you understand and that you believe will continue to do well, even though they'll never do as well as a really successful business that throws off 20% returns every year. You know, if that's the case and you need to make 20%, don't sell your business.
Right. And so in closing, David, what is it that you would say when you think about 230 people here listening, a mixed bag of people? We've got industry professionals, we've got other managers, we've got a lot of investors. What is sort of the key point that you would like to say to them to be thinking about with this sort of still unknown about what's going to happen?
Well, first of all, you know, yesterday when I was attending and I was seeing all of the different participants, I was proud to be part of the Canadian ecosystem of asset management generally, but alternative asset management specifically, because not surprisingly, you've been able to get to attract a cast of best-in-class managers to present. And the first thing I would do is congratulate them for having navigated through an incredibly unusual and significant event period and done a very good job along the way. And to the investors, I would also tip my hat to them, like chapeau, that many investors, even in the face of all of the behavioral biases that we discussed, in the end did the right thing, you know? And it's one thing to say, here's the right thing to do, but it's another thing for them to actually latch onto that. And so as long as investors continue to approach the problem as this is my team today, but I'm always looking at what my team might look like tomorrow, and I can attend a conference like Karen's conference to determine, you know, who the next players up for grabs might be, you are doing your job. You are not assuming that things are static and you're always looking around. That doesn't mean that evergreen strategies don't exist. It just means that you always have to assess whether today's portfolio should be tomorrow's portfolio.
Well said. And what an absolute great keynote and session. Your presentation style, you know, I really just want to validate, I'm sure many people will agree with me that you put things in a way that is really helpful. So thank you, David, and really appreciate you being here. I hope that you'll stay aboard. And I know you're busy, but if anyone does want to get in touch with you, they can do that through Introduction Capital or directly. But again, thank you for your time.
Thank you. It's been my pleasure. And thanks again for having me. And congratulations on a fantastic event.
Thank you so much. See you later.
You bet.